Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Todd, thanks for taking some time to join me.
My pleasure.
Today we're going to talk about portfolio construction, about the business, about culture. Recently caught up with a few of the guys in the team and have done a few of these over the years. We did one a while ago remotely. And I think you pointed to the door behind you and you were saying, such and such, this is the door through to the master's chamber, so to speak. And we had a lot of good insights from that. It was one of our more popular episodes of all time, actually. So this one's kind of like a round two, but in particular, we want to talk about portfolio construction, how you think about that, how the Souls business stands apart from the rest of the market, so to speak. Got a lot of shareholders that listen to this show. I wanted to start off with the track record and how you think about that. I've got some numbers here that were to the period ended 30th April 2024. I'm going to read off my script so I don't get it wrong. The business, Soul Patt, had compounded around about 12% per year, which means that you've outperformed the All Ords, which has been going for quite a while. So that's really impressive, to say the least. So how does Souls, at the highest possible level, continue to do that?
Yeah, well, I mean, it's not by doing anything quickly. It's all about compounding. So when we think of those 20 years of 3% outperformance above the All Ords index, when you compound that, it means that we've more than doubled an investment in the index. And so it really adds up. So it might not sound like a lot, 3% per year, but it really is quite challenging to do, to get that outperformance whilst also managing risk and to do it repeatedly. And so I've spent my 20 years at Souls, trying to understand what the secret sauce is. And I've been, really thinking long and hard about the track record. So if I go back 40 years, I think the compounding return is over 15%. So they've been doing something right for a long time. And, I think it's as simple as reducing each investment decision down to a simple, disciplined process and not doing anything silly. When I think about, that sort of famous Ben Graham quote that the investor's biggest difficulty or worst enemy is himself. If you can just overcome that challenge and what's happening in the market and the noise that's going on, I think that disciplined decision-making goes a long way. But I wouldn't say that our business is, particularly, that we have exclusivity over simple disciplined decision-making. We have a few structural benefits in our business that we really try to exploit. So when I think about our business as compared to a typical funds management business, we have permanent capital, which is really important. If you think about a typical fund manager, they're always looking over their shoulder, worried about if they make short-term decisions that depart from the benchmark and they get it wrong, or they might actually just be early. They might be right, but they're early. 6 or 12 months of poor performance means redemptions and outflows, and that's existential for their business. The other thing that we have is the flexibility. So we don't have a mandate. So most fund managers are given a very tight mandate about what they're allowed to do, how they do it, concentration limits, all of those sorts of things. And we just have this ability to go anywhere whenever the time suits, what the market suits, where the opportunities are, whatever asset class that is. So it's really important for us to allow ourselves to exploit that opportunity. And the third thing that I would say that we have, which is sort of structural, is our reputation. 120 years, been around a long time, people know us, trust us, and actually we become a source of preferred deal flow. People want us to be their investor, and particularly people who have a choice about who they can go with will choose us because we've proven that we can be a reliable long-term partner for them. And in fact, it's the people who have a choice that are the people that you want to invest in, not the people who are so desperate that you're the last person that they're seeing. So I'd say those three things are what sets us apart.
It's interesting that you bring up the comp versus a traditional managed fund. As one of my questions actually is, people we hear about, in the industry, also in the media, how difficult it can be to be an active fund manager and create a track record anywhere close, even 5 years, right? Let alone 10, 20, 40, however long you want to go back in Soul's history. How do you exploit those? Like, you have some crystallized examples, or maybe just how you think about sharpening that advantage, that edge that you have over the traditional forms of capital?
Well, you're right. I mean, it is very difficult to beat the market. That's the first thing that people don't understand. And if you look at the funds management industry, the data is published by Standard & Poor's every year or every half year. And if I look at the latest research for 2023, and if we just look at general equities in Australia, 77% of fund managers underperformed their benchmark. And it actually gets worse the longer you go on. So if we look at a 15-year track record, 85% of fund managers underperform. And what Standard & Poor's does is another interesting piece of analysis. They bring back, so that we don't sort of end up with survival bias, they bring back funds that have closed down. And what's amazing is if you look at that 15 years, there's a huge turnover or failure rate of fund managers. So it's a very difficult business, and it's not because the people in funds management aren't very smart. That, in fact, it's the opposite. They're incredibly clever people, and it's an industry that attracts the best and brightest. It's just that the investor, the person giving them the money, is the one creating the structural constraints that makes it difficult for them. And so, as I said, we don't have those issues. We're fortunate that we're investing a balance sheet that we inherited through a listing in 1903. So there was no sort of mandates back then, and so we're incredibly fortunate. So it's really just about how do we focus on our ability to exploit that. Now that might be, in particular, taking risk when the time suits, and so a lot of people say that we're contrarian or go against the trend, but the reality is, we're just in a position where we can not try to time the market, not try to pick the bottom of the market. We just look at things where they're obviously cheap, and the market is all seeing something different, and we can take that longer term view.
It was in catching up with the guys like Dean recently from your team. A lot of people, like, we talk about the Standard & Poor's, the SPIVA research that comes out. But you mentioned, if we go one layer deeper, that mandate piece and that advantage that you have is, it's not just Aussie shares, it's not just small cap shares. It can be, private credit, it can be whole businesses, parts of businesses, listed businesses, like all different types of things, cash, which is a huge advantage in terms of the flexibility that brings you.
Yeah, absolutely. And for a variety of reasons. I mean, one is, firstly, I think that investing is a relative game. So if you are only looking at one asset class, one industry, or one type of investment, I'd find it hard to understand how I can gauge whether that is a good investment when I don't know what I'm comparing it to. And so we've got the fortunate situation where we've got people across our business that are looking at all of those asset classes that you're talking about, and we get to have a discussion. Where is the best relative return that we can get right now for the risk that we're taking? And so we're constantly having that debate, and we're just funneling the capital to the best asset class. And so I think that that sort of generalist nature and that ability to go anywhere makes us better investors. But I think the other thing about that flexibility is you can be completely opportunistic and structure a solution that meets the needs of the person that you're talking to, and that ability is something that certainly people who come to us looking for capital, they enjoy that discussion, but also that structuring really allows us to get a little bit more than what the rest of the street's getting.
Because you could say they could walk in thinking that they want to do an equity raise and for you guys to support it. But someone in your team suggests, well, maybe this is a different option, this convertible note, or here's some debt, whatever the case may be, which works for both parties.
Absolutely. And I think the other thing that can be said about the different asset classes is it is a very good way of getting lower correlation between assets, which is, as you know, really important to constructing a portfolio. And, it's just a fact that asset classes perform in different ways in different parts of the cycle. So it's a really great way to mitigate risk.
How about then, so we've talked about one of the structural advantages that Souls has there with active funds, if we just put them side by side, but obviously another one is the passive side. So index funds, ETFs, these types of things. I'm kind of aware of many of the shortcomings of those, but some people think they're kind of like the one solution for everything. How do you think about like those in a portfolio? So how would you think about, say, Souls being in a portfolio relative to those structures?
Yeah, I think they're very different. I mean, we are an extremely active manager. And of course, we're trying to provide a complete portfolio of diversified assets across different asset classes, whereas what you'll generally find in an ETF or an LIC is that they, single asset type vehicles. Look, I mean, they're low cost. And as we said before, you're getting the benchmark is actually a pretty good outcome as compared to a lot of active management. So I can see what the appeal is. What I'm a little concerned about with those vehicles is that there's no one at the wheel. So, when things go off the rails, who's in control, who's making the calls, we get to sort of see massive problems with that. But, I mean, in the US in particular, we're seeing passive funds are getting up to near half the market volume. And they're, probably 25% plus here. Mm. So it's a big part of the market, a big part of the volume, and, a computer's in control. So that worries me a little bit. But they are, as I said, by and large, low cost, performance in line with the market. So there's not much to complain about. But we're certainly trying to beat the market. So if I think about that strategy inside our portfolio, the closest thing to it would be we've got about a 20% allocation to large cap Aussie equities, $2.5 billion. And you could replicate that strategy with an ETF. For us, we don't need to do that. We're fortunate that we've got enough money and enough scale to be able to employ our own team. And so with 2 or 3 individuals, we can manage $2.5 billion. So it's probably costs us less than what an ETF would, but we're in control and we're actually able to generate alpha. So in the last 4 months, we've probably done about 1% alpha on that portfolio. If you don't have the fortunate situation that we have, it's not too bad to have an ETF or LIC manage your money. I'd probably go with an LIC because you do get that active control. But for us, we're lucky that we don't need to.
Yeah. I think one of the benefits from a direct investor's perspective, and I've talked about this a lot, is particularly with Souls, is, sure, you get active management, but you guys, like we said before, can go anywhere. You got this go anywhere approach effectively. And that's very different. So most of the folks that listen to this would know that could never happen in an ETF vehicle because it's not a liquid asset. And you mentioned before, at the very start of the show, the idea that a lot of active funds actually underperform because the investors that are going into those funds expect certain things. Like if I go to the website and click redeem, that I'll have my money in the next couple of days, right? I expect that if the fund manager is, in strife, I can withdraw my money really quickly, and I don't want too much deviation in the, all those things. And it's the same to an extent with the requirements that public market investors have with ETFs. I click sell, I get my money in my brokerage account in the next few minutes. That kind of thing is what their ideal situation is. And yet we know that there's a premium that comes from illiquidity. There's a premium that comes from certain types of volatility and all these different types of, risk premia that you can get. But I think the structural advantage is one thing we haven't mentioned already is the ability to be long-term focused, because the structure and the unique structure, the permanency of that capital that you mentioned is also quite unique in that I think it was Tom who came on the show a while back. Maybe it was you even. I can't remember exactly. But even like the venture into AMP control, these types of businesses are long-term assets that I don't frankly know of many that have that view.
Well, I think, you raise a really good point about the premium for illiquidity. We're in the fortunate position where we can capture that premium because we don't need liquidity. The only liquidity we need is the cash to pay our dividend, but we get that money from the income that we receive from our portfolio. So we don't need our underlying investments to be liquid. And for an investor, they get the best of both worlds because we're capturing the illiquidity premium, but an investor can buy or sell shares any time they want. So a shareholder can come and go, but the fund is capturing that benefit.
One of the things, you mentioned LICs before, LICs. One of the benefits that I see of Souls is more like a cultural thing that maybe there's a way that you can represent this, but is this idea of like a lot of the LICs that we see are externally managed or there are different setups within the LICs themselves. A lot of investors tend to lump Souls in with LICs, which I think is misfortunate because I don't think that's fairly representing the business, the legacy, the brand, the multi-asset approach, the insider ownership, so many other things. But one of the things that really stands out to me is the cultural aspects of what you and the team are nurturing is one where it's, at least in my opinion, it seems like investor first, keep costs low, hire great people, keep them a long time, create more of that legacy. How do you, if someone was to come to you and say, oh, so it's kind of like a LIC, what would you say?
It's kind of like a LIC, but not, not at all. I mean, we are a listed investment company, but we're not a listed investment company.
Yeah, it's confusing to the outside.
That's right. And there's a couple of similarities. I mean, and there's lots of internally managed LICs. They tend to be the larger ones, and they tend to be the better performing ones. And so they also have permanent capital, which is really important and good. But what they don't have is our flexibility. And that's partly mandate, but it's also there's a taxation regime around LICs that requires them to not have high turnover of their portfolio, not have concentrated positions and things like that. So they lack the flexibility that we have, and therefore they don't have the ability to move into the asset classes that we do, be as active as we are, be as concentrated in high conviction things that we are. And so what you'll see with the LICs generally is that they will perform in line with the benchmark. And as we said before, there's no criticism of that because that is a pretty good achievement in itself. But you know there aren't many that are doing the sort of alpha year on year that we're doing, and that's what really differentiates us.
I think like you said, that legacy. Like there are some LICs that have been around for decades and decades and decades, and many of those are internally managed. But, you know, I don't think there's any that have been around as long as Souls, at least as far as I know. Maybe there are a couple, I don't know. But it's, you know, that speaks to itself as well as like the family, you know, the Milner family being involved and all the way back in time creates that kind of bond to the outcomes as well. I was fortunate enough to see a bit of a strategy day prezzo that was put together, I think by you. And in it, I should maybe add some context to this. When I was in funds management research, so I would research the funds, the active funds, the passive funds, ETFs, whatever. I would look at things called attribution and contribution, which is an analysis the fundies would do for us and serve it up on a plate. And it would basically tell us, based on factor models, where does their performance come from, like statistically speaking. And in the brief prezzo that I saw, you also included some of that. And I'm curious, like when you look at your overall performance, how does that fall apart? Like where are the components that drive long-term results?
It's not easy to say because the portfolio is dynamic. So over 20-year history, attribution is not perfect because the portfolio changes so often. So you can do attribution over a much shorter period because you can say I got my last year performance from this and I got a drag from this. But over 20 years, our portfolio has changed a lot. But actually for the first part of that 20 years, up until essentially the last 5 years, we had a highly concentrated portfolio of TPG, New Hope and Brickworks that were growing and dominating the portfolio. And I looked at that and said, well, that goes against a lot of people's principles around how you would ordinarily establish a portfolio and construct a portfolio. And actually, it was when I read Ray Dalio's Principles book, and he talks about the Holy Grail, which is about uncorrelated assets and how many uncorrelated assets you need to achieve diversification or the benefits of diversification. And it's really only when you get uncorrelated assets that you can increase your return per unit of risk. You could have a lot of different investments, but if they are relatively correlated with each other, you just don't ever get much of the benefit of diversification. And so even though we only had 3 investments, from an outsider's perspective, they said that's not diversified, but actually they were so lowly correlated with each other that whenever one was not performing, the other 2 were bringing it up. And so actually it was a very effective portfolio with just 3 stocks. I mean, we had a lot of other stuff in there as well, which made up the other sort of 25, 30% of the portfolio. But it just shows that correlation makes a big difference. So that's a big principle that we employ at the moment, is thinking about the correlation of different assets. And even though we had these low correlations with our major investments, they were still equity investments. They were on the ASX and subject to equity markets ups and downs. So started thinking about how do we get other asset classes to further diversify, and that was really the genesis behind the merger with Milton, to give us the capital to allow us to move into other asset classes, which we couldn't get from our existing portfolio because we had low tax cost bases. So if we sold TPG, New Hope or Brickworks, every dollar that we sold, we'd end up with near 70 cents in after-tax proceeds, and then you've got to go get 40% plus returns in your next investment idea just to get back to square one. So it really set a very high hurdle on us recycling the capital. So Milton was extremely important in our ability to generate further alpha for the next 10 or 20 years, but also to de-risk the portfolio by further diversification. So that's a big principle, diversification in the correct way. I mean, a lot of people think diversification is owning lots of stuff, and in fact, what they end up doing is just mean reversion. And you dilute your best ideas when you own lots of equities, and you're just going to end up performing in line with the benchmark. So that's a big principle. I mean, the other thing that we talk about in terms of how we generate performance is how we perform when the market is strong versus when the market is poor. And a large source of our outperformance actually comes from our ability to preserve capital when the market falls. So, we did an analysis, looked at the last 20 years, about a third of the months. So in the last 240 months, 81 months of the market were negative. When the market was negative, it fell 3.5% on average per month. And in each of those months, we did 2.1% better in each of those months. So, a lot of our performance comes from being able to preserve capital when the market is weak. And that comes from the nature of our portfolio, a very defensive portfolio. We have businesses that are robust, resilient, operate well in any part of the cycle, generate cash, low cost, these sorts of businesses that typically do well when the market is down. So I'd say they're the major ways that we sort of generate that outperformance. And we do it in a way where I don't think we're taking more risk on than the market risk. We're just employing those principles to engineer better outcomes for the same or lower risk.
It's interesting that you mentioned that kind of 5-year yard, a line in the sand. Do you think that the way, just generally at a high level, I've got some specific questions about private markets in a moment, but do you think that the way that you invest will be tweaked or evolve as you grow?
It's constantly evolving. We're constantly asking ourselves whether what we do is fit for purpose, right for the times, whether our asset allocation is correct. We constantly remind ourselves. I mean, at the moment, we've been allocating a lot of money to credit, as an example. But we talk all the time about there being potentially a time in the future where credit is no longer a good place to invest. We see credit as particularly attractive at the moment and for the last sort of 5 years because we can engineer better than equity market returns whilst protecting our downside. And so we're happy to give away the upside, but when you're generating sort of 14% returns across the portfolio, I don't really care so much about giving away the upside. But the good thing is that we're in front of equity and we've got downside protection mechanisms in place. And so that just seems like a really good way to invest at the moment. But credit is a mean reverting asset class. We're starting to see it in some sectors, not so much what we do, but there is certainly some areas of the market where the risk premium is getting quite narrow. There's a lot of competition coming into the market. So that's the kind of thing where we just have a view that if we stop writing checks to credit, that's okay. We'll find something else to invest in. There will always be something that on a relative basis will be something that we get excited about.
As I've tracked the business over the years, I've often been, I think it's maybe surprised like how much potential there is in that side of Soul Patt's business. I know that's like your background. You're well versed in that, right? Like you've been doing it for a long time. But that side of the Australian economy and business complex, if we think about it, is huge. And for most people that listen to this show, they don't have any direct exposure to that, and they probably won't get direct exposure to that. So using a listed vehicle such as Soul Patt is a great, like a gateway into that. And I think the question that I've had, I think I kind of aired this last time with you, was more so along the lines of like, so you say private credit, yes, with your remarks just before, but private equity, right? As a, the place, the door that people want to knock on, companies want to knock on first is Soul Patt's, right, here in Australia. Is that a slither of the business that can keep growing, or even credit, if you think about it as well, 5, 10, 20 years into the future? Is that something that shareholders can look forward to?
I think credit has some constraints about how much it can grow. I mean, there's only so many of the kinds of deals that we're looking for. We have very high expectations about what we earn from credit.
Right.
If we wanted to reduce that, we would be able to build a much bigger portfolio, but that's not what we're trying to do. And the reason we don't come down in terms of the coupon that we're looking for out of our credit portfolio is we've set ourselves a discipline of saying that our hurdle rate is our cost of equity. So, so we look at, and I would say that our true cost of equity is actually lower than the market because our beta would be lower. But just for simplicity, we say, well, let's just think about what the long-term total return of the market is, and it's about 8.5%, 9%.
Mm-hmm.
Well, let's just not do anything lower than that. That becomes our floor. And so what we're trying to do is engineer a portfolio of assets that is no worse than that, and we go up from there. And then that's how you sort of collectively get to a position where over the long term, hopefully we can continue that sort of 3% alpha. And so we have that discipline, and that's why the credit portfolio does what it does. But it relies on highly bespoke, bilateral, proprietary conversations and deal flow that is not easy to find, particularly at scale. And we've got $1 billion fund, so we've probably got 20, 25 positions, so roughly $40 million each. To find to put a $40 million check to work and get that kind of return, you've got to work pretty hard. So I wouldn't say that the opportunity to grow credit is massive, but it's a fantastic part of our portfolio and great source of income for us, but also a great sort of uncorrelated, downside protected asset class. Private equity, I think, is different. I think there's really a lot of very good private businesses in Australia that would love for partnership capital to help them grow and come on a long-term journey to build a business. And there's actually no other capital at scale that does what we do. If you think about the private equity industry, it's dominated by leveraged buyout funds who want to own 100%, gear up the business, fix it up, and then sell it in 5 years' time. If there's somebody who doesn't want to sell their business but does need meaningful capital to CapEx, buy a competitor, buy out a partner or whatever it is, there's not very many people who will say, I don't have a defined timeline on when I need the money back. I'm happy to come with you on the journey. We're not going to tell you how to run your business. And all we want to do is just see you continue to grow and keep doing what you're doing. That's a great story for those people. They love that, and there's just not very much competition. So, of course, that means that we should be able to get a better entry price as well because we're just not competing with anyone. So I think there's lots of opportunity there. We've seen that business grow from almost nothing. I mean, and we've been investing in private equity for several decades. I mean, if you look at New Hope and TPG, they were private equity investments.
Yeah.
And eventually they get to a point where they're big enough, the governance structure is right, we can put them into the public domain. But when they're growing quite rapidly, we think that being private has its advantages because you can really make quick decisions to fund things. You're not worried about short-term expectations about profit and all that sort of stuff. So, a lot of as soon as you go public, you succumb to the investors' will to see short-term performance, whereas we can sort of put them into or warehouse it for a while without constraints about whether they're paying us dividends or making longer-term investment decisions that will pay off in time. So I think private equity has real scope to grow. It's already growing pretty quickly. We're up to about $1.5 billion now in 3 years. And when we got started with our private equity investing again, and it was only once we got the capital from Milton that we could really start growing. We picked out some thematics that we were interested in. We've executed on sort of 4 of those 5 thematics already. And while we've been putting a lot of money in, it's actually growing at, it's been sort of growing 20% IRRs per annum, and that's without a lot of leverage. So we're not putting the same sort of risk and leverage that an LPO fund would put into those investments.
I think that's a really exciting part of the ecosystem, and it's particularly reassuring for people that hear things or read things about companies stay private for longer, there's more private companies, will they need the ASX, will they need the US markets, whatever, public markets. So to have exposure to that, again, is really interesting to a lot of folks. And it, for your loyal long-term shareholders, I think provides a lot of comfort when you talk about IRR of 20%, 14% on credit. Sure, they are what they are in terms of their size. You still have meaningful exposure, underwrites dividends, underwrites reinvestment potential. And those 4 thematics, which we spoke about previously, are really interesting. And they're really common sense type businesses and industries. They're not, when people hear of thematics, they often think of these really sexy dressed up funds and they come out, they do all right for a bit and then they flop. These are things that are underpinning a lot of what we do, whether it's in the industrial sector, swim schools, whatever the case may be, financial planning, investment management, like these are all really interesting industries. And I saw a similar thematic play out. And obviously you guys have recognized this for years. It's like the reason that private credit as an asset class has really got its own kind of moment in the sun is because the big banks pulled out and there was a desperate need in the Australian investment market for businesses like Souls to enter and say, hey, here you go, we can help you. We're permanent capital. Or even if we're not, we can help you this way, this way, this way. And then on the private equity side, I don't know, as a business owner myself, I think I couldn't imagine anything worse than someone coming and taking full control of, like, say, the brand that I manage, kind of leveraging it up, packaging it, and then, for lack of a better word, flogging it off to someone else. And in the meantime, who knows what's happened. So that is a really interesting thing that you guys can bring to the market. I'd like to switch gears a moment and talk about some of the resources that you, as a person that steers the ship, what are the resources that you look to? Like, it could be podcasts, books, or resources. You mentioned Ray Dalio Principles before. Full disclosure, I have not read that. I've read a lot of the other, newsletters, different works, watched all the masterminds and that sort of stuff. Howard Marks, I know, Buffett, for example. Who are you looking to, and where are you getting your information on the daily, so to speak?
A wide variety of sources. All of those things that you mentioned. I mean, Ray Dalio sat down and tried to put all of his things that he's learned over the years, some related to investments, some related to life and running a business, and he tried to put them into a book, and it's fascinating reading. I read all of those sorts of books, whether it's Munger or Buffett or Howard Marks. Frankly, I enjoy things that are principles for life that, I find those a little bit more interesting than the daily, what's happening in the macro environment and interest rates going to go up next week, or I consume that too, and I do listen to a lot of podcasts. I read all the newspapers every day, but I get a lot more out of books that try to give you some good learnings for life that you can utilize for the rest of your life. And I'm also obsessed with behavioural economics. That's a bit cliched to say these days because everyone is. But I'd say that the growth of behavioural economics has sort of tracked my career, and it probably wasn't nearly as well known or understood when I started out as it is today. But some of those sort of principles around avoiding cognitive biases and how people think, and how you can use psychology and economics together to really think deeply about investments, and so all of those books are now commonplace. Everything from Freakonomics and Moneyball and Nudge and Thinking Fast and Slow, and all of those sort of things that were revolutionary at the time, but now seems like everybody's read them, and people like Charlie Munger and Warren Buffett have made them very famous.
Yeah, there's a website called Farnham Street, named after, I think it's Buffett's home. Farnham Street's written by a guy called Shane Parrish, who runs the podcast The Knowledge Project. We were fortunate enough to have Shane on the show last year, I think it was, and that's my go-to for all things ideas, mental models. And it was probably, yes, it is the result of Charlie Munger just trying to knock everyone's heads together to say, hey, there's more to it than just spreadsheets and financial forecasting. There's this whole other thing in this world, and you can use the best ideas from those other disciplines to come together and do what we do, which is fascinating. That's why I love poor Charlie's Almanac. You could see over the decades as he did those speeches how his thoughts had evolved or not, and they remained ever present. And I just love that. I've already listened to it a few times on Audible this year. So there was something that I did want to bring up with you about this, which was about that kind of that long-term thinking. In a way, does sound a bit cliche, and we all love to call ourselves long-term investors and be close to rational as possible and what have you. I'm interested in how the team, how it's built or how it forms or how the process is formed so that you can try and avoid some of those biases that do creep into groups as well as individuals.
Yeah, I think it's. I think if you're aware of them, that's the starting point. So you know what to look out for when there's a cognitive bias that's kind of impacting your decision making, and then if you can have everybody being alert to those things, and have a culture where people can openly bring up and say, I think what you're doing there is recency bias, or you're anchoring to something, and so we really do hold each other to account. It really is a collegiate culture where we're making decisions for the whole business, and people aren't sort of siloed in thinking about how do I maximize my own portfolio, or how do I just go about my business regardless of what's happening in the rest of the portfolio. We feel a deep sense of responsibility for the portfolio as a whole. And so I think when that happened, you've got that's the first line of defense. The second line of defense is the investment committee / board / Rob Milner, who has to have a sense check of whatever we decide that's beyond a certain amount and is a meaningful investment. But I think if you just got multiple lines of defense, you're alert to whether you're getting caught up in the moment, whether there's a strong fundamental reasoning behind what you're doing that's evidence-based, thoughtful, diligenced, and we get excited about finding those little pockets of opportunity that other people are missing. Someone said, "Oh, I want to invest in this," and And he said, why? And I said, well, because everyone else is. I mean, instantly that would get called out in our place. But if someone says, I think everyone's missing this and here's why, we all get really excited about that. And so hopefully that sort of helps us to avoid some of the pitfalls. And, we see them from time to time where you can just see that the market is obviously missing something. If I think about a few years ago, and we're a meaningful shareholder in Regis Healthcare. When COVID was hit and there was COVID throughout the community, and the regulatory environment for aged care was poor, a lot of the industry was not making money. No one wanted to know it, and I think Regis was trading 90 cents. And we liked it so much that we actually bid for the whole company. We didn't get there on that, and they were right about that because there was a lot of upside in the business, and today it's sort of between $4 and $4.50. But at the time, nobody wanted to know aged care. And it was just obvious that with the amount of demand coming for those services and the undersupply, we couldn't have a regulatory environment that didn't allow it to be profitable and for it to grow and for further investment to accommodate the future needs. So we knew all of these things had to change, and that just seemed like a very simple thesis to us. Similarly with coal, about the same time, 3 years ago, thermal coal prices were $50 a tonne. It was sort of peak ESG, and everyone was saying this means the end of coal. I mean, obviously that wasn't going to be the case. At that time, 45% of the world's energy consumption was coming from thermal coal. You couldn't switch it off overnight. You couldn't switch it off inside a decade or two. And we also knew what the operating costs were for the industry, and $50 was an obviously unsustainable price. And we hung in there and bought some other assets, and the coal price went to $400. So, in hindsight, it looks like the most easy and obvious thing, but at the time, no one was doing it.
I guess that's born out of the process and the length of tenure in the team too, and the kind of, you've seen this story before. This has played out once before, which actually was a question that I was told to ask you. Because you'd be the best place to answer this one. So that's like a process that is implemented daily, weekly, monthly, quarterly, whatever. How about for long-term benefits and long-term, cultivation of a team of people within the organization that can be sustained, can, illustrate and demonstrate the values, even when you're not in the room, or even when Rob's not in the room, or someone in the senior management, that there's the next generation of person and they're going to act the same way or similarly to what you would. There's a few questions around this, but I guess one of them is, like, how do you incentivize people to live up to those values and the principles that you set down, not just you, but like the broader senior team?
Yeah, there's a bit in that. I mean, and because I'm so obsessed with psychology and behavioural economics, there's an interesting study where they put a person who's walked into a waiting room of a doctor's surgery. Everybody else in the room is an actor. The person walks in unaware that everyone's an actor. And then there's a bell goes off and everybody who's in the room stands up. And the person looks around and says, okay, I guess I better stand up when the bell goes. Don't ask anyone why. When they do, the other person says, I don't know, that's just what we do. And slowly what happens is they rotate out. So another member of the public who's unaware of the study going on comes in, one of the actors goes out. The bell goes off, everyone stands up. Over time, what happens is all of the actors exit the waiting room and everyone who's in the waiting room are unwilling participants in this psychology study, and they're all still standing up when the bell rings. And so there's a couple of things to learn about that. I mean, one is just the nature of humans, that they comply with the culture around them. And secondly, that you don't need the original people in the room for the room to still be participating in the same way. And so my job, and this is the way I think about succession and the way that Rob thinks about it as well, is to pass down those those cultures and values and behaviours so that people just live and breathe them, so that over time it will live on. And so it's much more about people just overlapping with each other and having universal acceptance and compliance and a desire to want to carry on those values and behaviours that makes them enduring. And so, we absolutely have that. Everyone subscribes to the culture. And in fact, it's really interesting because in the last few years, we've grown the team quite a bit as we've increased the volume of what we do post-Milton. We've moved from sort of 30 to 60 people. And the biggest challenge is to ensure that we keep the culture alive with that growth in the team. And I'm happy to say that it absolutely has. It helps that you've got a culture that people want to buy into. We've been very lucky. But when it comes to incentives, I think it's an interesting thing as well, because that's another area of focus for me and the way that we invest and setting up the right incentives. And so it becomes a sort of pet topic of mine. And I've also got young kids, so I think about that as well. And I was thinking the other day, when the kids have made a mess with their toys on the ground, you could incentivise them to clean it up by saying, "I'll give you some pocket money or a treat." But actually, what that would probably do over time is incentivise them to make more mess and wait around for you to come up with an incentive to clean it up. So there's two kind of lessons about that. One is the incentive is wrong. So the way that you should incentivise people is not to make any mess at the first time in the first place. But the second one is I don't really want to incentivise my kids to clean up their mess. I want to build an idea into my kids that they're motivated to achieve and be disciplined in and of themselves. So without me pushing and without me telling them that they're going to get a little reward every time they do something good, I want them for that to be intrinsic to them. And the same with our business. I mean, we don't set up incentive structures that tell people exactly how to behave. What we do is we attract people in the first place who are innately driven to succeed. They want to win. They get the joy and the thrill out of doing something good. We don't have to sort of when you've done a good job, when you've done a bad job, and you want people who are driven by that desire to succeed. And I think that's probably the biggest thing that we can say about our culture is that we have a bunch of people who come to work every day motivated to achieve great results for shareholders without some eye on what they're going to get out of it.
And you're going to front them every now and again, just like tonight when you go down the street and say good day to them. So you said that people do. It helps that you have a place where people want to be, which. Yeah, clearly. And the tenure speaks to that of the team members as well, not just yourself, but basically everyone. When you think of the next wave of people, and this is more a hiring question, so it's not just about young people, it could be about anyone, but is there anything that you do as a business, as an individual perhaps, anything that you might consider like fundamentally important to the way you recruit, hire, onboard people, and indoctrinate them into the Soul Pat's way, so to speak? Like, is there anything in particular that you do to attract those types of people?
I don't think we do anything remarkably different to anybody else, but I do think, I mentioned this to you last time when we were talking about it, there is a bit of a bias towards people who have demonstrated that they have the self-motivation to achieve things in their life without having them sort of gifted to them. So these are people who, just worked extremely hard to better their situation, whether it's in their school or academic career or outside of work. They like achieving great things, and I think you get a sense of those people who that's what motivates them. And it's important. The people who are going to succeed in our business are people who are self-starters and motivated to achieve. And so we don't tend to get a lot of people from big organisations who've had that structure and process driven. We're a very unstructured environment because that's investing is hard and complicated, and it's the bit in the in between the lines where you can make the money.
Yeah, it's multidisciplinary and multi-asset class and structure and everything that you guys do. I didn't know you did such big shareholder kind of roadshow things. So that's really interesting for folks that are existing shareholders, but for people that aren't, they can head to any of their brokerage accounts and type in SOL, that's the ticker symbol, and read some of the recent updates and take a look at the business and see all different types of information. So I'll put links in the show notes to that, as well as the Soul Patt's website and things that we've done previously, not just with you, but with the broader members of the team. Given this is the second time we've spoken, normally on the first time I ask for advice that you give to your younger self. So that's already been done and dusted. So the other question that I have for you today is, if you could leave folks with one thing that they could take away from hearing this, whether they're investors, whether they're not, just investors in general, business owners, what have you, what would you like to leave them with?
Well, I think some of the things that we've spoken about is, firstly, that investing is hard. It's hard just to beat the benchmark. It requires a lot of discipline, a lot of effort. And I'd like to think that Souls can show that there are simple things that you can do to be able to get good outcomes. Mm-hmm. I'd hope that people would be able to think about what their competitive advantages are and think about ways to exploit them. I also think around portfolio construction, it's not just the uncorrelated asset classes, but also really thinking about timing of investment. People spend all their time on security selection, and the analysis that we've done, and we've looked at some sort of academic research around this, and about a third of your returns come from security selection, 1/3 comes from the decision to invest and when to invest, and 1/3 comes from asset class. And a lot of people ignore the 2/3 and spend so much time thinking about where they can, what security they should invest in. So I'd urge people to think more broadly, and I think Australians are underinvested in asset classes beyond equities. So there's a bit more to it, but I think following some simple methodologies helps, and I'd like to think that we've shown that there is a way to do it. But if people don't want to do it, they can always come and buy a Soul share and know that there's a dedicated team of management who are here to service our shareholders and hopefully deliver great outcomes over the long term.
Yeah, I like it. And you've definitely got a principles reader in me. I haven't read the book. It's sitting on my shelf at home, and I looked at it and I think I'm going to need a bit of time to get through that one. But I will. And some of the great books you referenced about behavioral finance, behavioral economics, so important to understand yourself and to get good investment outcomes, in my opinion. So, yeah, I think what you guys do at Souls is wonderful. I think it stands out as very, very unique and very good in the Australian marketplace. And I mean that sincerely, in the sense that you always try to find people that are trying to do something different, but they have to do something different and execute on it. It has to be a genuine idea that can be repeated and result in success ongoing. So that's definitely the case in what I see from Soul Patt. So Todd, thank you for taking the time to join me while you're remembered.
Thank you very much. It was a real pleasure.
Thanks, mate. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.